Good afternoon. Last time we had a financial crisis, 12 or 13 years ago, we spoke a lot about the role of covered bonds in supporting stability in the banking system. We all know that covered bonds are very good at stability. And the Vienna Initiative, I think one of the key parts of that was about trying to give banks more funding independence, more reliance on stable funding tools. This time around, the financial crisis is very different. Not even politicians can blame the banks for this one. And we've got a situation where the banking sector isn't shrinking, but the economies are. The regulatory response has been very different. It hasn't been about stability. It's been about trying to fund growth. We've been reducing counter-cyclical capital buffers. We've been reducing MREL requirements. It's the focus on growth. So are covered bonds still part of the solution? Or do we have to hand over the baton to our racier colleagues in the securitization market? Now, personally, I believe that there is a key role for covered bonds in the Build Back Better agenda, but it's going to take adaptation. Adaptation in terms of the rate environment, in terms of the products, in terms of our approach to credit. And I think that the role is particularly obvious in Central and Eastern Europe. It's particularly obvious in the funding of green assets, and it's particularly important in the Euro accession countries as they prepare to join the ECB. And it's very important in expanding the extremely low levels of home ownership in a lot of the region, or home ability to buy funds, I should say more accurately. The ability to buy your own home for the average citizen is probably as important as Brexit, Trump, and global warming combined. And I think the covered bonds have got a key role to play in that. This afternoon, we're going to explore those topics. In the second session today, we're going to look at the new frontiers of covered bonds in terms of the assets and the countries. But today, we're going to have a little bit of a look at the market as it stands today. To help me do that, we have the panel that you see in front of you, a very balanced panel, if I can say that. We have an issuer, we have an intermediary, we have an investor, and we have a lobbyist. Defne Akarcali is the Senior Investment Officer with the IFC, with responsibility for investments in financial institutions in emerging Europe. Luca Bertalot, probably you already know, he is the Secretary General of the European Covered Bond Council, responsible for lobbying on behalf of the industry in Brussels, and increasingly over recent years, functioning as a facilitator of the financing of energy efficiency mortgages. Andrej Hronec is the head of Treasury and the ALM in VUB Bank in Slovakia. And last but not least, Matthias Melms, who's the head of DCM and Syndicate for financial institutions and SSAs in Helaba. Thank you all very much for joining us today. And Matthias, I'd like to start with you, if I can, by giving a bit of an overview. I was thinking of just asking you for an overview of the overall market, but I understand you have a particular reason to be interested in the market today. Can you share what you've been doing this morning, Matthias?
Hey, Richard, thank you very much, and a warm welcome from my side to all of you joining the conference. I have received very good news this morning, as we have seen the first Czech issuer issuing a euro-denominated covered bond as a public deal. So Commercial Banker was today in the market with a 500 million no-grow deal, and they print that deal at a level at a fantastic tight plus 12 basis points. And the demand for that deal was really overwhelming. So the books before allocation were at 1.5 billion for this 500 million no-grow. So it was 3 times oversubscribed, and that demonstrate, from my perspective, especially the demand from investors for exactly that type of deals from the CEE region. And we have seen that before, that we have fantastic outcome from issues from Slovakia, for Andrej's deals, for example. We have seen fantastic demand for Polish covered bonds denominated in euro from PKO and also from Hronec. And last year we had a fantastic demand for Luminor deals. So that's the whole overall picture, is that there's a real huge interest for investor to invest in the CEE region in this covered bond format. So, and I'm pretty convinced we see a similar demand for similar deals that are coming up in the future. So the message from today's commercial banker is really fantastic demand for fantastic assets from a fantastic region.
Fantastic. Congratulations. And thank you for making it nice and topical, bringing that deal today. I don't want to belittle the achievement in any way. It's obviously a fantastic achievement, and I know how difficult a first deal like that must be. But in general, conditions are quite benign at the moment. We do have a very nice situation for issuers. How does that, and a question for all of my panelists, how does that change the approach to the market and the way that you think about funding yourselves when things are so good? Matthias.
So besides this inaugural deal from Commercial Banker today, which shows a 5-year maturity, which is absolutely fine for an inaugural deal, issuers tend at the beginning of the year to choose long and very long maturities in the covered bond market because of the overall yield environment and because of the fact that the ECB has announced in December next round of TLTRO. Issuers fear, and we could see that at the beginning of the year, that there's only limited issuance, means limited supply in the covered bond market available this year. So that creates a situation where we have foreseeable negative net supply this year in the market, which means that investors tend to buy everything, and especially at the long end of the curve, as long as they were able to get a positive yield. That means that the issuer could really issue not only in the long, but at the very long end of the curve this year, or at least at the beginning of this year here in January. And the deals we have seen so far, UniCredit Germany, means HVB, was in the market also with a 15-year all-covered bond with a really huge demand that demonstrates that's a real interest from investors, giving the issuers the possibility to maybe tend longer as they planned before.
Andrej, I guess you hear that from Matthias quite often. You hear that the market is an incredibly strong situation, issue early, issue often. What's your response? How do you think about this very benign environment when you think about your year's funding plan overall?
Yeah, well, for the issuer, it's basically the best what can happen, that because you don't need exactly to time the market. You actually can issue whatever you wish because there is the demand, even ECB is buying. So naturally, what Matthias mentioned, that the issuers tend to issue longer. On the other side, as in case of EUB, if we have, let's say, the outstanding covered bonds not in a huge size, then if we issue for, let's say, 10, 15 years, we have a risk that then to roll over the existing, let's say, covered bonds issued, we will not be able to come to the market each and single year. Yeah? And if our ambition is to really regularly issue, then we are a little bit constrained not to issue too long, because otherwise, basically, it might be that if we issue today, let's say 15 years, we will not have enough, let's say, pool to bundle and issue a covered bond in the next 1 to 2 years. Yeah? So that's why basically we have these two tendencies. If the outstanding covered bonds is sufficiently large, I would fully agree that let's issue 10, 15, even 20 years. If it's not the case, probably to do it too long doesn't make that much sense. Yeah, because really, in case, for instance, of EUB, our aim is really, if possible, to come to the market each year at least with one issue.
And definitely, what's good for Andrej, definitively as an investor, I guess, is bad for you. Could you tell me a little bit about, first of all, your approach in the region and your view on the points that Andrej and Matthias have made?
So to highlight, first of all, Richard, I guess for the benefit of all the audience, I represent the International Finance Corporation, part of the World Bank Group. And again, I'm sure quite a few people are familiar with it. When it comes to Europe, as IFC, we invest in only a small part of it, what I would define as emerging Europe, and probably the most emerging. So when we look at the EU member countries, our scope is relatively narrow. We're talking about Romania, Bulgaria, and then Serbia and Croatia, which of course I shouldn't forget. So as an investor, we would definitely welcome covered bond issuances at any time. I guess especially these days when volatility is quite high and predictability is quite difficult, it still definitely remains as a safe haven. Trying to look at it from the issuer's perspective also, based on the many discussions that we've been having with our clients, banks mainly in the region, the ample liquidity in the market, it's somehow hindering, I shall say, any kind of plan, I think, on the longer term issuances or on covered bond. And I'm sure we'll touch upon some of these factors later. But I do have a feeling that at least when it comes to our horizon of the banking sector in the region, the focus is relatively on the short to medium term. So at least as an investor in our part of the world, we haven't seen a lot of supply on covered bond issuances or plans, therefore.
That's something that certainly from the investor side, you'd like to be able to promote. You will be there. Also from the structural side and the technical cooperation side, is that something you can help with?
Yes, definitely. And of course, together with our colleagues at the World Bank, who work together with the regulators, the governments, on developing the covered bond framework, in particular in countries that are not directly covered by the directive. It's something that we would work together.
Thank you. One of the overwhelming factors, we've already touched on it a bit, is the ECB and their purchase program and the vast distorting effect that they have. Now, clearly this is good for the overall health of the market, but there are some very specific problems with crowding out, problems with liquidity, problems with allocations policy. If you could be Madame Lagarde for the day, if you could dictate the ECB's policy on the covered bond purchase program, what would you change about it, Matthias?
So, of course, I don't have the charm of Madame Lagarde, so it is just a hypothetical question. But saying that, you have to view that from different angles. The ECB has a mandate. I don't have a mandate, so I don't have to care about their mandate. And if I would have a wish, and what I could change, I would clearly stop buying covered bonds in this market, because they have taken away in the past, since 2014, such a huge amount of covered bonds, and under the APP and under the pandemic purchase program, that it is really hard to say that you have a functional market where you have enough liquidity, especially in secondary market. So definitely I would like to see them not being active in that market anymore, because you don't, not only having them on secondary market, taking away the liquidity there, but they are also active in contrast to the SSA and the Gabi markets. They're active in primary market, so that high quality investors get definitely less allocation. So and exactly this investors are still investing in covered bonds, but not the amounts that they would like to invest. And I also have to say that because of the demand of the ECB, levels where the swap are very attractive for issuers. Saying that, on the other hand, also investors want to earn something, and the levels we observe in the market are definitely much tighter than they would have been without the ECB. So to summarize that, if I had a wish to Madame Lagarde, I would say, please leave the market. But I repeat that for 7 years now in a row. That is no new wish.
It's not newish, and it's probably a little bit optimistic.
Yeah, I know.
And Andrej, Defne, or Luca, do you have any thoughts on assuming that they do have to still be in the market? if there's any better ways that they could operate?
Okay, if I may start, actually I agree with Matthias. I would just add one thing, that there might be times, and obviously we have seen it last year in March, when the market is shaky and so on. So in that times, ECB has, let's say, some value, so to step in. But in good times, as we see today, actually they could really disappear from the market at all. So both on primary and secondary. And I agree with Matthias that probably they cause more damage than some, let's say, value creation, because really market should be about price discovery. Unfortunately, if the central banks, both on the govies and on the covered bonds and so on, are too active, then the levels are basically absurd. Just to give you an example, Slovakia government bonds are trading at the moment at par with Germany, which actually is absurd. Yeah. Normally, it would never happen. Okay, we can discuss whether the pickup should be 20, 40 basis points or whatever, but not at par. Yeah, and this is basically the consequence of ECB.
Okay, is there any other opinions on that, or Luca, you're on mute, Luca.
A few words from my side. I mean, of course, it will be not my intention to give any wish or desire to the Madame Lagarde, but I mean, it's very clear to us what we can do to facilitate as ECBC the work of the lenders into the market. As I said in my intervention a few minutes ago, we are creating a special task force for understanding better the needs of the investors. We consider the ECBC has a role in channeling the complaints and the information to the ECB. We have an annual meeting and we have a constant contact with the ECB where we provide feedback from the market. And this will help the European institution to map the situation. We are deeply aware of the complexity of the situation in front of us. It's not only the covered bond market, but we have to see this as the entire symphony of the problems that we see into the market. And we are acting very seriously as a catalyst, providing the right information to the right moment. And it's very important that the information that we get from our analysts, Matthias and others, that are really helping us in getting the mood of the market. And we channel this information to the right place, either in Brussels, either in Paris or in Frankfurt, to the right floor, to the right person. This is what we can do. We are very aware that we are in front of a very fragile situation, and the European institutions so far are playing all the cards possible to fix the problem as much as possible to fix the problem. So this is the role of the ECBC, and we try to play this with the support of all of you in the right way. Thank you.
Understood. Thank you, Luca. Another role of the ECBC has been providing a platform for issuers to talk to the market. And I think that a lot of information has come out in the course of the last year about payment holidays. A lot of it is reflected in your transparency templates, the status of the cover pools backing it. And we've got a fantastic snapshot of what the underlying collateral looks like right now. But I'm going to ask a much more difficult question. Because you weren't in the pre-panel, you get the difficult question. How do you see the credit of the covered bonds, not now, not 6 months from now, 3 years from now, given everything that's gone on?
Well, that's, I think, one of the key questions for the coming months. As you know, we have created a COVID task force that is looking at this issue very carefully. We have a monthly update of our information, actually bi-weekly update, where we try to monitor and to take action. We, of course, we share this information with the European Commission and with the competent authorities to provide a timely information of the state of play of the quality of our product. On top of this, as you correctly said, we have amended the harmonized transparency template to provide investors with timely information about credit quality in the portfolio of the different banks. To answer to your question, it's the NPL discussion. It's a very broad discussion that Europe is trying to tackle. We have seen the publication right before Christmas of the action plan on non-performing loans. The covered bond product is reacting very well. We don't see major stress from the information that we have received from our members. We try to have a medium long-term view. We are not very concerned, but we are concerned about an impact of disposable income to general borrowers in Europe. So we have invited country and member states to continue the moratoria, to try to protect the quality of the covered bond as much as they can. I think that the European Union is intervening for the first time on the social aspect. We should not forget that the plan SURE, which is more or less an implementation of the German system in the previous crisis, has really helped enormously several countries in manage this social situation. So this is helping the Union to manage the non-performing loans issue in a decent way. We hope that the situation will continue to be under control. Of course, we are monitoring very carefully. We are coordinating action directly with member states because, as you know, fiscal solutions are of competence of not only of the European Union, but for member states. So we try to intervene, and we have a group of people very specialized, one representative per country, able to step in and to intervene when is needed. Thank you, Richard.
Defne, if I can ask you the same question, basically, from on the sharp end, as an investor, what's your perception of the long-term credit aspects?
So this is not about covered bonds specifically, but obviously the impact of COVID yet remains to be seen. Given the ongoing moratoria in many of our countries of operation, it's difficult to assess. I think many of the banks, the potential issuers, are in a much better condition today than they were in the last financial crisis. Given that, you know, from not only capital point of view, but I think on a risk management point of view as well, they're much stronger, better regulated, based on relatively hard experience. So that does give us some comfort, but nevertheless, I think the next 12 months in particular are going to be really important for us to be able to assess the real impact of COVID on NPLs. And obviously, you know, coming closer to the covered bond market, the impact on unemployment, on the housing market and whatnot. At the same time, since development impact is always critical for us as an investor, as IFC, hence the development impact of investing in covered bonds may become even more valid in terms of providing increased access to finance for housing when it comes to underdeveloped countries especially.
And Matthias, are you focused on the bank credit, or are you more concerned about the state of the underlying assets in the housing market?
On both, Richard. So, and I completely agree to Luca. I think we can't underestimate the impact of the SURE program of the EU to the residential housing market. That really helps to stabilize the housing market in this deep crisis and prevent million people in the European Union for getting unemployment. That is a really great achievement and demonstrates the benefit of the European Union, not only for the single countries, but for all people living there. And I'm really so thankful that we have, in contrast to other countries who fight for a long time. If the people there get a check about $600 or something like that, that we have the instrument in the European Union that helps to stabilize the housing market, the residential housing market. Completely different story. It's a commercial real estate market. We know from previous crises that we see impacts normally at the end of the crisis there. I'm really not sure how deep this crisis will be, but what I can say is at the beginning of the crisis, the banks in the European Union, independently of the CEE or in other regions, were in pretty much better shape because of the regulation we have seen after the financial crisis. So I'm pretty convinced that the measurements help to get the covered bond product really in a good shape through the crisis. And remarkable overall was that at the beginning of the crisis in late March, we have seen widening of the spreads in the covered bond market as well in other markets, but not so much widening as in all other crises before. So the stability of the covered bond market was pretty convinced also because of the activities of the ECB was much higher than in the past, and because of the measurements we have seen from the governments, from the EU, and the measurements that were taken on the regulation side after the great financial crisis really helps not only the housing market but also the banks to withstand this crisis. And I'm pretty convinced that the impact will be less deeply than we have seen after the GFC or through the GFC.
It could be a bit of a slow burn crisis as we come to the end, hopefully, of the pandemic itself, and we start to withdraw all those measures that, yeah, maybe we start to really realize the credit implications. And Andrej, can I actually ask you two questions? Firstly, can I ask your thoughts on that and on the credit perspective? And then secondly, if I can ask just about the practicalities of funding in this environment. Presumably, most years you've got a reasonably good handle on funding requirements. It must be very difficult to know what your funding needs are going to be in this environment. Can you hear us, Andrej?
Okay, so firstly, just let's say to add one comment to the topic before. Firstly, just let's say to add one comment to the topic before. Okay, I had some noise. You hear me? You are on mute.
We can hear you now, thanks.
Okay. Okay, so let's say just one comment to the previous topic. Actually, since many governments imposed the moratorium on mortgages, for instance, we will really probably see only this year the spike in NPL levels and so on. So at the moment, it's really premature to estimate, let's say, the potential impact. I agree with Matthias that probably we are only at the beginning. Hopefully, it's not a deep recession or, let's say, crisis, but let's see. And basically, in this same manner, I would answer also, let's say, the question on the funding. We are in an environment which is basically extremely uncertain. Yeah, so really to estimate what's going to be the funding structure, funding possibilities, funding mix in the next 1 to 3 years is difficult. What let's say I try to, and we try in our bank to, let's say, how to focus on the current situation is to be more careful. Yeah, so if possible, restructure the funding mix in a way which will be more stable in case of, let's say, potential shakeout in the economy, some recession and whatever. Yeah, so this might not be the case, but let's say just be better prepared. Also, that may have a consequence that if we issue covered bonds, let's say, approach the market, if the conditions are well, or let's say at these, let's say, good levels, potentially increase the duration of the covered bonds. So really be cautious, be grateful for the market as it is, and let's see.
Thank you. I'd like to move on to regulation and ask everybody which aspects of the regulation have actually influenced their life. The regulation and the policy responses have influenced their lives most. Before I do that, though, can I just remind listeners, if you do have any questions, please pop them into the chat room and they'll get sent up to us. So please do communicate if you've got anything you'd like to ask. But yeah, given all the regulatory responses, Defne, what aspects have most changed the way that you approach, well, everything that you do? What are the most significant parts?
So when we say regulations, that's quite a broad umbrella, and I'll take it as. So trying to consider the most important ones at the moment. I think we have mostly talked about the moratorium and whatnot, or that kind of intervention from the local central banks, as well as the ECB policies on quantitative easing and whatnot. MREL is an important topic, definitely, for us, and I think for many of our issuers, especially the ones in the EU countries, in terms of being able to meet the MREL requirements. And I think there could be a debate as to whether that will hinder to a certain extent the covered bond issuance, given that they're not bail-inable and therefore are not MREL eligible. So, you know, when we look at our potential issuers, banking clients, the focus is really on whatever would be considered MREL eligible, especially because of, as I mentioned, the ample liquidity in the market. So they would issue MREL only if they have to, although that would be relatively expensive for the issuers. Of course, for covered bond, it's probably less the case. And then the EU taxonomy is another important development in this world, and whether this will impact the covered bonds. It's quite welcome for us in the sense that as IFC and many other IFIs, we've been trying to convince and impose the eligibility criteria, the green eligibility criteria, and support climate finance. So this will be really welcome to bring in a unified approach. And again, the translation into the covered bond universe, I think, is going to be quite important.
MREL and the taxonomy. The taxonomy I would certainly like to come on to in a little bit. Before I do, though, can I ask Andrej and Matthias first, which parts of regulation or policy changes have most influenced you? Bearing in mind you can't say MREL because Defne's just said that. Who wants to go first?
So then I take the question first, which has the most influence. Although Defne has just said it, I would say MREL, definitely, but we shouldn't underestimate the impact on the covered bond directive, especially for CEE regions, where we have, in some countries, deep developed market, but in most of the countries, we haven't seen covered bond issuance yet because of a lack of covered bond laws. I have just realized that the Croatians, for example, just introduced, or shortly before introducing, a covered bond law, for example, and I'm pretty convinced this is also because of the EU directive. And we all also know that other countries in the CEE region are working on covered bond law. So I think the EU directive really kicks up the speed in introducing this product in the CEE regions to that country that we haven't seen so far in that market. And from the covered bond perspective, I would say maybe the EU directive is more important from the overall perspective than MREL, but on banks especially, it is MREL.
Okay, I will add, let's say, in case of Slovakia, obviously the directive, well, I think we all agreed it's a step in the right direction. In case of Slovakia, since we had amended law on the covered bonds in 2018, so I would say most of the things which will be touched on or are touched on in the new directive are already implemented in the let's say, local legislation, so which is positive. So actually, in our case, we will need, let's say, certain adjustments, but rather minor. Yeah? So let's say we are well positioned. So I don't expect any major, let's say, implications on the local banks. Yeah? So in case of Slovakia, it should be easy.
Luca, I'm going to restrict the question a little bit to you if I can, and just focus on the taxonomy. Defne's already brought that topic up. I understand you've got a problem with the taxonomy. Could you share your beef with it?
Well, allow me to complement the discussion that we have seen in the last 2 minutes to say that for me, there was allow me to say, Danish answer. There is a Basel is one of the major underlining, I think, question mark for the upcoming legislation. So I think this we should not underestimate the impact that the macroprudential framework could have on the covered bond space. I think it's very important that we look very carefully what's going on the Basel implementation. On taxonomy, I think you are right. I mean, the European Commission is putting a lot of energy, allow me to play with the words, in finalizing the taxonomy delegate act. The delegate act was supposed to be approved the last day of 2020, but the European Commission, as we all know, received 46,000 comments that they were supposed to digest in 9 days between Christmas and New Year's Eve. So probably will be postponed of a few weeks, and consider the political background, a pre-sounding with the Parliament and the Council is required. But we expect that they will remain very ambitious in the technical parameters, which is making most of our members very uncomfortable. One of the most problematic aspects is that taxonomy will include as a full taxonomy compliant only EPC, Energy Performance Certification Level A, which is really, we're speaking about 1% of the building stock in Europe. So is removing critical mass for the banks and is really challenging the capacity of the banks to support the European Union in this effort. So we were very much in favor to a more comprehensive approach. Most probably, the European Commission will remain in this very ambitious approach. We have a plan B. We are producing an energy efficiency mortgage label, which will actually cover much more than taxonomy probably, and will identify a green section in the mortgage market and covered bond market to probably provide a privileged treatment in terms of prudential treatment. So we are working very close with the European Commission. I think that if the Commission has a very strong ambitious and they want to have a benchmark legislation with taxonomy, I think that I see the point in this situation. They want to show global leadership in the argument, but it's very important that banks will be allowed to enter and to help families to improve and renovate their house as much as they can by having a special prudential treatment. We are working for this. Be with us on the 12th of February. We will announce this publicly that we have an energy efficiency mortgage label. We have already 66 pilot phase banks with us. We are sure that we can make the difference by providing a new European benchmark for a proper prudential treatment, whatever taxonomy we will get in a few weeks' time.
Thank you. And I didn't mean to imply that you were objecting to the taxonomy in general. I just knew that that one specific point to the definition was problematic. Does anybody else have anything that they'd like to share, either narrowly on the taxonomy or more generally on the possibility of green covered bonds or green bank finance in the sector specifically, before we move to a question from the audience?
Maybe Richard, just on green, but I mean, of course, ESG is a big debate. What are the IT solutions we have to implement for producing ESG data? I think this is generally a transversal issue. But allow me to say a few words about LCR eligibility. We are still expecting the LCR eligibility. And well, the Brexit deal has been concluded, but financial services discussions are still outside of the package. And the LCR debate will influence the third-party equivalence, which will arrive in a few years' time. So these coming months, I think that we will see a lot of intense negotiation between Europe, UK, and also the rest of the world. And the UK-Europe divorce can have some influence in the third-party equivalence. So we have to watch this space very carefully. If I understand correctly, if a European investor is now buying UK covered bonds, they will be eligible only for 2A, so they have lost the 1B eligibility. And in the reverse case, for me, it's very tricky because if a UK investor is buying a European covered bonds, this will be eligible for 1B and 2A for 2 years because they have a provisional. And after this, it will only be in 2A. I have to say, sorry to say, but I mean, the ECBC and the covered bond lobbying was more, I will say, careful of other industry because covered bonds anyhow will remain in 2A. Probably securitization will not be eligible because they never achieved the LCR status. So when we helped the European Commission to draft that section, we were not even thinking about Brexit at that time, a few years ago. But I mean, the drafting of the LCR for covered bonds with the third party, with the third countries, was actually a very smart move that helped in mitigating the risk of having a trigger effect for covered bonds. So I wanted just to mention that LCR is also a very important point. We should take a very careful look at this space.
You had to bring up Brexit, didn't you? Matthias, I think you wanted to comment as well on this.
I just want to give a short comment to green covered bonds. So what we overall observe that the outstanding amount of green covered bonds is still low in comparison to traditional covered bonds, just talking about a benchmark size, a little bit more than 30 billion euros, in comparison to overall volume of roughly 1 billion euro denominated benchmark covered bonds. So you see, and on these figures, that we are still talking about a really small market segment. But what we all always see is that there is an overwhelming demand from more and more green investors, not willing to accept the status quo with investing just in traditional asset, but especially want to invest in green covered bonds. So, and the outcome is that the deals that are flagged green, or at least in the last 12 months, also flagged sustainable, they have, all other things equal, a much higher demand from investors, and that expressed the needs for to originate such type of assets in a covered bond format, which I know a lot of banks have a lot of efforts on this topic, but the overall process is extremely complicated. So what I expect is that we will see in the coming months, and of course in the coming years, more and more green covered bond programs, and more green covered bond issuance activity. But the demand is undoubtful, is really there, and the need is there for such assets. So I think we are not at the end of the wave. We are just at the beginning of a wave of green covered bonds issuance, and especially green covered bond investments. So I'm pretty optimistic on this market segment. I think green is the overall topic in the next years, and maybe in 10 years' time, we are talking about the traditional market as a green market, and there's no other market anymore.
Currently, is there a pricing differential for green covered bonds versus traditional covered bonds, all other things being equal?
At the moment, I can't observe that there is the tighter pricing of green products in the covered bond market. What we still observe in other formats, like senior preferred or the senior non-preferred, is that there is a possibility for some issuers to price through their traditional curve with green products. And I'm pretty convinced that we're not so far away from seeing that green covered bonds are also tighter than traditional covered bonds. So it's just a question of time from my perspective.
We've got very little time left. Got one question that I'd like to ask from the audience. Thank you for whoever sent that in. Which CEE jurisdiction do you see most attractive for covered bonds, and which one did best in 2020 in your definition of best, whether it's yield or size? Andrej, you're probably biased, but maybe everyone else, which CEE jurisdiction do you think is the best on your criteria? Who wants to have an opinion? Go on, Matthias.
I take this question. Overall, we have to underpin that is extremely nice to see that more and more jurisdictions overall joining the covered bond market. and that we see new issuers in the market that underpins this product is extremely attractive for banks. Although Commercial Bank issued their first Eurobond today, I would say that underpins exactly that example, the attractiveness of the market, and can only say congrats to the guys at Commercial that they issue this bond today. When you talk about best, I have to say, I would say the overall covered bond market did best last year in mid-March to end March, beginning of April, demonstrate again that even in the deepest crisis, that there is demand from investors that for that product. And this is covered bond product is overall the lifeline for banks. Okay, besides the ECB, which is a really big lifeline, the lifeline for banks to the market. And it was a nice example to see that our Canadian friends were able to issue in the Euro market in March during the lockdown. So for what else more can you ask to demonstrate the liquidity of the market? This was an incredible situation to see that even in that hard times, the market was open.
It's a nice diplomatic answer. I expect nothing less of you, Matthias, and congratulations once again on the trade today. Unfortunately, we have run out of time. There are a lot of topics that we would like to address, but we sadly don't have time to do that. Please join me in about 20 minutes' time, where we're going to look at the new frontiers for the covered bond market, the new jurisdictions, the new asset classes. That's in about 20 minutes on the same place. Click on the same place. Just leaves me to say thank you very much to Defne, Andrej, Matthias, and Luca for joining me today. And thank you very much for following us.